This system is completely broken. 1,000 nursing homes have shut their doors since 2020. The ones still open charge on average $9,000 a month, and even more are closing every week, and the burden is about to default onto you. Pay attention now before the crisis hits your kitchen table.
70% of Americans over 65 will need some form of long-term care. Most of them will not be able to afford it. There are currently 220,000 fewer certified nursing assistants working in this country than the system needs. Nursing home employment is still 12% below where it was before COVID. The average nursing home aide earns under $18 an hour, which is why the turnover rate exceeds 70% annually. Facilities are closing because they lose money on every Medicaid resident they serve. 1,000 nursing homes have shut down since 2020. The ones still open have cut staff, cut services, and cut Medicaid beds. Quality has declined as costs have risen. And the insurance market that was supposed to pay for it looked at those numbers and walked away. Here is why the system broke, what the government can claim from the home you thought you would inherit, and the steps that keep your family from losing tens of thousands of dollars or letting a court decide what your parent should have chosen. Most families only find out after the crisis hits. This is how you get ahead of it. The numbers are not hidden. Genworth's 2024 Cost of Care survey puts a private nursing home room at $9,034 a month. That is $108,408 a year for one parent. A semi-private room is $7,908. Assisted living is $5,350. An in-home health aide at 40 hours a week runs $6,000 a month at $33 an hour. There is no version of long-term care in America in 2026 that costs less than a second mortgage. Most families only see these numbers when the crisis is already here and the choices are already gone. States pay nursing homes about 86% of what it actually costs to care for a Medicaid resident. Operators lose money on every Medicaid bed. 60% of nursing home residents paid through Medicaid. The math has not worked for years. 1,000 nursing homes have closed since 2020. The ones still open cut Medicaid beds first. Private pay beds last. The families who need the most help have the fewest options. The shortest waiting lists are at the facilities most likely to close next. The staffing shortage is what makes all of it worse. Nursing home employment is still 12% below pre-COVID levels, according to the Bureau of Labor Statistics. The workers left are stretched across more residents than any safe staffing ratio allows. In April 2024, the Centers for Medicare and Medicaid Services proposed a new minimum staffing rule: 24-hour registered nurse coverage in every nursing home and 3.48 hours of direct care per resident per day. The shortest waiting lists are at the facilities most likely to close next. Insurance was supposed to fill the gap. It did not. Genworth Financial, the largest individual long-term care insurer, stopped writing new policies. John Hancock left the market in 2016. CalPERS raised premiums by 52 to 77% between 2014 and 2021. The private insurance market saw the real cost curve and decided the risk was uninsurable at any price a policyholder would pay. The market did not fail by accident. It ran the numbers and left. When all four systems fail, a fifth option appears: a reverse mortgage. Officially, a home equity conversion mortgage, or HECM, is a HUD-backed loan for homeowners 62 and older. It turns home equity into cash with no monthly payments. The full balance is repaid when the home is sold or the borrower dies. 50% of HECM borrowers now report elder care funding as the main reason for taking the loan. That number is the signal. When half the people tapping home equity are doing it to pay for a parent's nursing home, the system has already failed. The family home is now the last resort funding source for a gap four other systems were supposed to fill. The burden landed on families by math, not by accident. Medicare and Medicaid were signed into law in 1965. The framework was built for a nuclear family with a full-time homemaker providing unpaid care for aging parents. Female labor force participation in 1965 was 39%. In 2026, it is 57%. The unpaid caretaker the system counted on is present in 39% fewer households than the framework was built to serve. The framework stayed the same. The household changed.
Hey everyone, real quick to jump in. If you want to take advantage of this crisis, links down below. 4 courses, real estate crash cycles course, the crash bundle. It's everything all in one. You're going to be blown away. Links down below. Now let's get back to this video.
Nearly half of adults in their 40s and 50s have an aging parent over 65 and are also raising a child or supporting an adult child. That is the sandwich generation. Career interrupted on one side, retirement savings squeezed on the other. A full-time job running through the middle. 21% of family caregivers report their own health as fair or poor. 1 in 5 people carrying an aging parent through the system is doing it while their own health is slipping. The caregiver becomes the next patient. The AARP Valuing the Invaluable report puts the cost of that squeeze at $470 billion in unpaid labor every year. The part most families do not discover until it is too late is called the Medicaid Estate Recovery Program, known as MERP. It is a federal requirement passed into law in 1993 that requires every state to file a claim against the estate of a deceased Medicaid recipient to recover what Medicaid spent on long-term care. If a parent spent 3 years in a nursing home with Medicaid covering the bill and then died, the state has the legal right to file a lien against the parent's estate, including the house, to recover what was spent. The home the family assumed they were inheriting can be claimed by the state. This is not an obscure edge case. It is federal law in every state. Most families learn about it after the parent has already been on Medicaid for 2 years and the 5-year planning window has closed. Here is what changes the outcome before the crisis takes the decision out of your hands. Start the long-term care conversation with your parent this month, not after the next fall. What do they want? Home care, assisted living, or a nursing facility? Who makes medical and financial decisions if they cannot? Where are the documents? Where are the documents? Without that conversation and those documents, a court appoints a guardian when your parent can no longer act. That process costs $5,000 to $15,000 and takes 6 to 12 months of legal proceedings, while the family is already in crisis. The conversation is uncomfortable for one afternoon. Not having it is uncomfortable for the next decade. The second is Medicaid 5-year look-back planning now, not when the nursing home application is being filed. Medicaid requires any transfer of assets from parent to child to happen at least 5 full years before the application date. Transfers inside that window trigger a penalty period when Medicaid will not pay for care, even if the parent has no assets left. If Medicaid is part of the plan, an elder law attorney and a documented asset transfer plan need to be in place before the 5-year clock starts. Get 3 legal documents signed and notarized before your parent loses capacity. A financial power of attorney to authorize someone to manage accounts and financial decisions. A healthcare proxy to name who makes medical decisions when your parent cannot. An advance directive to document specific wishes for end-of-life care. Without all 3 in place before capacity is gone, a court appoints a guardian. Expensive, slow, and public. Check the Veterans Aid and Attendance benefit before writing the first check to a nursing facility. This is a monthly pension for wartime veterans and surviving spouses who need help with daily activities like bathing, dressing, eating, and mobility. To qualify, the veteran must have served at least 90 days of active duty, with at least 1 day during a period of war, and meet certain financial and medical need criteria. The benefit runs about $1,500 to $2,500 a month, depending on status and care needs. It is one of the most underused federal benefits because most families do not know it exists until they are already paying out of pocket. Check eligibility at va.gov. Make aging in place home modifications before the crisis. Grab bars in the bathroom, walk-in shower conversion, entry ramp, stair lift where needed. Each modification costs a fraction of $9,034 a month. 2 extra years at home instead of in a facility saves more than $250,000 compared to a private nursing home room. Many states offer HCBS waivers, Medicaid-funded programs that pay for home modifications and in-home care as an alternative to nursing facility placement. The benefit can be significant, but slots are limited. Wait lists in many states run 1 to 3 years. Apply before the fall, not after. 53 million Americans are already in this moment or moving toward it. The ones who got ahead are not the ones with more money or more time. They are the ones who moved before the crisis made every option worse. When long-term care policy changes and new programs open or close, we track it before families find out the hard way. Economic Ninja is out. Thank you for watching and stay informed.